Plug Power has been one of the more disappointing stocks in the market in 2024. Even if you zoom out in the last 3 years, the stock is down over 90%. I've been following this stock for several years and been telling investors to avoid this stock. I've had it rated as a sell the entire time I've been following this company. I'm going to revisit this company and update my recommendation for Plug Power stock. I'm going to look at its latest developments to determine if the lower price in conjunction with the latest developments means it's finally time to buy this stock on the dip, or if you should still be avoiding this underperforming alternative energy company. So let's take a look at the latest developments for Plug Power stock investors. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So like I highlighted, Plug Power stock underperforming, down 54% year to date in 2024. If I zoom out for the 3 years, it's down 93% in that time. Of course, hopefully you listened to my recommendations here with Plug Power stock. I've had it rated as a sell and I last updated it on May 9th. That's why I thought it would be a good time to update my recommendation on Plug Power stock. It's been a few months since I visited the company, evaluated the financial statements, and looked at the valuation to determine if it's finally a good time to buy this stock on the dip. Now, looking at its financial statements, unfortunately, the results look to be going in the wrong direction. Total revenue of $143 million in the latest quarter was down from $260 million in the same quarter last year. So there isn't revenue growth. There's actually revenue going backwards for this company. Meanwhile, the gross loss increasing to $131 million, up from $78 million. And the operating loss increasing to $244 million, up from $234 million in the same quarter last year. And if you look at the first 6 months that ended June 30th, the company's operating loss increased to $504 million, up from $443 million in the same 6-month period last year. So revenue decreases and losses increasing, right? That's the opposite of what you want to see when you're investing in a company. You want to see revenue growth and you want to see losses shrinking or profits increasing. You're getting the opposite with Plug Power. And of course, with all these losses coming on the bottom line, the money has to be coming from somewhere. And unfortunately, the money is coming from investors like you. The company's diluting shareholders, selling more and more shares. And now it's up to 737 million weighted average shares outstanding. That's up from 598 million in the same time last year. So they've added about 140 million shares in the last year, which is about 25% shareholder dilution. Well, when you're losing that much money on the bottom line, selling shares is one of the only ways you can survive as a company. The other way is to borrow more money. But if you borrow money, now you're adding interest expense because this company is in desperation mode when you're losing this much money. And so when you go to lenders and you try to borrow money when you're losing this much, they're going to charge you sky-high interest rates. So they prefer to sell shares instead. Now, one saving grace for the company could be more loans from the Department of Energy. They have been able to get some loans here and there from the Department of Energy, nowhere near enough to support its operations. What this company needs is the business to be on a sustainable footing, to be able to keep costs below what their revenue is. And unfortunately, they're unable to do that. They've been unable to do that. It's a business model foundationally doesn't make sense. They need to either be operating at such a larger scale where their economies of scale kicks in and they can generate sustainable profitability, or they need to raise their prices so much so that it offsets the higher costs. And if they raise their prices to their customers by so much, then their revenue is going to decrease even more than it's already decreasing. So Plug Power is in a very difficult situation and really in need of government help. The government really needs to step up and help this company if they want it to survive, because at this pace, they're heading in the wrong direction and they're heading there quickly. They're losing a lot of money on the bottom line. So this company is not in a good position right now. If we look back longer term, you'll notice that they have generated some growth in the earlier years, but that has been reversing. 684 million in revenue in the trailing 12-month period. That's down from the peak levels. It was at around 800 million. But this company is smartly realizing that the more revenue they generate, the more money they're losing on the bottom line. So maybe it's smarter to get the business under control first before looking at revenue growth. They need to make sure that the incremental revenues are leading to better performance on the bottom line, because they can't afford to lose more money on the bottom line. They need to put the path on a sustainable footing. That's the priority here, is getting the unit economics of the business in better shape before they look at anything else. That's the priority here. Of course, the government loans and government grants, that's another area they should be focusing tremendously on, because that's just a nice shot in the arm for the company. It gives it more time. But ultimately, they need to get the business on sustainable footing. No amount of money from the government will keep this company alive if they're not on sustainable footing. Because if the government gives them $5 billion, even if it's not a loan, let's say they give it to them for free, and they're still losing money on the bottom line, eventually they'll burn through those $5 billion. So the ultimate saving grace for the company will be getting the business on sustainable footing, while government grants will give it more time to do that. See the operating profit margin, negative 165%, and no improvement over the last decade. Bit of a big volatile change here, down and up. That's an accounting irregularity. Overall, they've been negative, and they've been negative for a long time with little sign of improvement. And similar story with cash flow from operations, negative 132%, and little sign of improvement over the last decade. They've now got net long-term debt of 151 million. That means their long-term debt minus their cash is 151 million. That, fortunately, is not a big problem for the company right now. They do not have significant sums of debt in relation to all of their other troubles. Debt is not up there as one of their top troubles right now. Return on invested capital, negative, and showing no improvement over the last decade. You can see here from negative, let's say 40% here in 2016, and it's been volatile since then, but no real improvement, no demonstrable improvement upward for. So it's now trading at a forward price to sales of 1.415. This is the cheapest this stock has been in the last 3 years, but justifiably so, right? I showed you nearly every metric about the company is heading in the wrong direction and is on unsustainable footing. And so it should be trading at a cheaper and cheaper valuation as it continues to move in the wrong direction. So unfortunately, I'm still keeping this stock rated as a sell. I haven't seen enough improvement to justify lifting this stock out of my sell rating category. Hopefully they will make some improvements going forward. I'm rooting for this company. Unfortunately, they haven't been able to get it together just yet. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.